Hey guys, Jake here. Welcome back to the channel. In today's video, we're going to go over the different kinds of market type orders that you can place when buying and selling stocks. Perhaps you're brand new to trading and you've been using Robinhood or Webull, or maybe you've been trading for a while on one of these other great platforms. Here is a screenshot from my Charles Schwab account, and when I go to buy a stock, for example Apple, it gives me 5 options. I can do market order, limit, stop, stop limit, and trailing stop. It's the exact same 5 options when I go to sell: market order, limit, stop, stop limit, and trailing stop. In today's video, I'm going to explain all of these different options to you. First thing you have to understand is a market order, and a market order is you saying, I want to sell my stock right now, or I want to buy a stock right now. And for example, we'll go with XYZ stock. XYZ, currently the stock ticker price is giving you $100.10. What that means is the last sale on the New York Stock Exchange occurred for this amount, $100.10. However, there is always a spread occurring between what sellers are asking and what buyers are bidding. So currently there are people looking to sell XYZ stock, but they're requesting the amount of $100.20. So sellers are asking high, and buyers are bidding low. There are buyers who want this stock right now, but they're placing a limit saying, I'm not willing to pay more than $100. When you place a market order, you're saying, give me the best price within that spread. So if you're looking to buy, you might end up going to what the lowest seller is asking, $100.20. Or if you're willing to sell right now, you might go down to what the highest buyer is bidding, which would be $100. The great thing about market orders is it gets you in or out of the stock pretty much instantaneously. There's like a small, less than a second delay. The downside is that a lot can happen. When you load the screen and you look at what the bid and ask spread is, it can change. It can change, in a matter of seconds. There are tens of thousands or maybe even millions of trades occurring within that minute that you're typing in how many shares you want or what you want to pay for it. So when you place a market order, there is a small chance that when you hit return or initiate, the price is already fluctuated. So it even will give you that disclaimer that, the current price that you're seeing is not the price you will get. Hopefully it would only vary by a couple pennies or a very small negligible amount. But once again, that's the downside of market orders, is that you don't know exactly what price you're going to get. And for that reason, traders get very nervous about market orders, which is why they invented all of these other ways to buy and sell stocks. There are limits, stops, stop limits, and trailing stops. We're going to go through all of these sell options first because I feel like that is easier to understand. The first one is a sell limit. So you already own the stock and you're saying there is a minimum price that I'm willing to sell my stock at. So I'm willing to sell it at this price or better. So perhaps you own 100 shares of stock XYZ and the stock is currently rising. You set your limit price, what you're willing to sell at, maybe $110. As what the market orders are filling at rises above that amount, your shares start selling immediately. Traders might want to do this in order to lock in certain gains. They say, hey, I bought this stock, I'm waiting for it to appreciate maybe 5%, and then I want to sell it at this exact price so that I can lock in a fixed gain. A sell stop is the opposite of a sell limit. This is when you say there is a minimum dollar amount that I'm willing to sell my shares at a loss from a current high. So if you say, I think stocks might be going down, if they reach a certain dollar amount, I don't want to lose any more before getting out of this stock. So you say, I own 100 shares of stock XYZ. My stop price is maybe $90. As the stock price falls, as market orders are being filled, if it crosses that threshold of, let's say, $90, where you say, I don't want to lose any more, I want to stop my losses on the ticker price, then as it goes below that 90, you start selling all of your shares at a market order. However, you need buyers to fill this market order. So if you own a lot of shares, let's say hundreds or maybe even thousands of shares of a stock, As you trigger this stop price, you continue selling as the stock price continues to go down, which is why you can implement a sell stop limit. So in the previous example, let's say your stop price was $90 and you have a couple hundred shares that you want to sell below that price. Well, as you're selling them, as you're filling them with market orders for whoever is willing to buy them now, the stock price could continue to drop. And let's say you have a stop limit price, meaning if the share price gets down to 70, then I'm losing too much. I don't want to sell any more shares if the sell price gets below $70. So that would be your stop price of 90 and then your stop limit price of 70, saying if it gets below 70, I'm just going to hold on to the stock. I'm going to hopefully wait for it to go back up before I then unload it because I'm losing too much on this sale. A sell trailing stop is really interesting because you're basically setting a fixed amount, either a percentage or a dollar. So let's pretend you say I'm going to put a sell trailing stop of $5 on this stock that I own. As the stock price goes up, your stop is always going to remain $5 below whatever the high was. So let's say it started here at 100 and then it went up to maybe 105. Well, 100 is now your sell trailing stop. So the green dotted line would be down here. However, it then went down maybe $1 in price. It then shot back up and it's now at, let's say, 110. That is your new local high. So your sell trailing stop is for a fixed dollar amount, $5 below the share price. So if it hits this high, it then goes down a certain percentage or dollar amount, let's say $5. The price gets down to 105. Your trailing stop price then triggers and you're saying sell all my shares once it's dropped by a certain percentage or dollar amount from its local high since I placed the order. So once again, this green dotted line continues to go up whenever the share price goes up. So it's kind of like a safety net where you can always be caught maybe 3% or a certain dollar amount below whatever the price has been as the stock price goes up. So those were the 4 selling options. We are now going to cover the 4 buying options. And the first one is a buy limit. A buy limit is the maximum amount you're willing to pay for a stock. So let's say we have stock XYZ, it's hovering around $100. When it starts to drop and it gets below 90, this then triggers a market order purchase. So you're saying, I want to start buying shares of this stock up to 100,000, whatever you requested. And as long as it stays below my limit price, $90, I want to fill this order. Now I need to clarify with limits and stops, this isn't a guarantee it'll ever happen. When you set a certain percentage or dollar amount for a limit or a stop, it might never hit that price. So it's up to you how you want to time it. Say this is good for just one day only, or it's good until I cancel it. You have to be very careful when you initiate on certain order types and then when you time when they end. And once again, there is no guarantee that it'll ever actually happen. A buy stop is the opposite of a buy limit. This is where you think once the stock starts trending up, you want to then jump on that train. So let's say stock XYZ is hovering around $100. It then sharply goes up, and let's say it hits 110. That would be your stop price in order to start buying. You think that, based on your trend lines, that it's going to go up dramatically once it hits a certain price. So then you say, hey, at this price, trigger a market order and then buy a certain number of shares. Once again, you would do this if you think that there would be a sharp increase once you hit a certain dollar amount. A buy stop limit order builds on the buy stop, where you say, hey, once the share price hits a certain dollar amount, I want it to then go back down a little bit before I start buying. So let's say it's hovering around $100. It then shoots up to 110. It triggers your stop price, but you don't start buying until the share price goes back down and then goes below your stop limit price, let's say 105. Why you would want to do this, you think once again a sharp increase will occur, but then there will be a downtick before it then goes back up sharply. You never know. This is just once again an option for buyers. The last order type we have is a buy trailing stop, and this is when a stock is trending down and you want to buy into it once it turns, once it starts going up again. So let's say we have stock XYZ that is trending down. Once it hits a local low and then starts going back up by a certain dollar amount or percentage amount, you set that, it then triggers a market order to start buying. So let's say we have stock XYZ, it was up here at $100, it then dropped down to 80, it then went up to 85, so it went up $5 from the local low. It triggered a buy order. You start buying into the stock after it's already bottomed out, or at least that's the idea of it. Okay guys, there you have it. Those are the 4 types of sells that you can do and 4 most common types of buys you can do, in addition to, of course, market orders for buying and selling. Thanks for watching, guys. If you made it this far, give it a thumbs up so the algorithm knows it's good. In addition, leave me a comment down below if you have any questions about buying and selling market types. In addition, consider subscribing to my channel. I post weekly about finance and investing topics. And until the next video, guys, take care.